Don't let the bear market put you down or make you feel down. Honestly, there or like for anyone, you should actually check out DeFi Llama. I'm going to post it here on the chat, and I'm saying this mainly because one of the really interesting things about crypto this year has been real world assets. This subsector has been going in an up only mood since the beginning of the year. Its TVL right now, it has grown to almost 900 million, whereas this industry did not even exist a year ago. And it's crucial as well to highlight this because it's not exciting. There's no Ponzi aspect to it. It's actually just implementing and adopting the technology to its full potential. And if you really want to cut through the noise and have a better sense of where this industry and this technology is headed, real world assets is your perfect example. The shining light in the midst of a very gloomy first half.
Good afternoon, everybody. Welcome to another analyst call with your beloved 21 Shares research team. Today we have Karim and Lina, my beloved colleagues, and myself. For the agenda today, we're just going to look at some of the top trends in the industry. We're going to just start off with the current state of the market, what's going on with the Bitcoin price, also tied in with financial markets and some other news. Then we look into fundamentals. We really go back to fundamentals because as the bear market is here to build, and that's why we're going to have a recap of some upgrades and current proposals that are going on for most of the important projects. And lastly, we're going from a very crypto native topic back to a very trendy topic, and this is real world asset tokenization. Tokenization, it's a big buzzword, but we want to have a look like what's going on in that sector and how is it developing. So let's start off with the current state of the market. I think, as you might know me, I love to look at the charts and see what the Bitcoin price is doing. So as you can see, like at the moment, we're trading a bit above 26,000. I think it's really clearly to see, if you see the purple line, that's the support line around 25K. It has been acting as a resistance in the past, but over the last 12 months, actually, it has been pretty strong support. And as you can see, we had this breakdown 2 weeks ago due to the fact there was a lot of rumors around SpaceX, liquidations, and so on. And since then, we have been consolidating around this line. We had a nice little pump over the last 24 to 48 hours. We have some new ETF application, a spot ETF application in the US, which sparked some interest and some hype in the market, which could be a reason for that. And also, obviously, there's still very much low liquidity and low trading volume. And therefore, yeah, every move in the spot kind of pushes prices quite significantly. Has been major liquidations as well. Obviously, nothing comparable to what we saw like 2-3 weeks ago, but obviously we had a little short squeeze. If we look at this, I want to just talk about traditional markets real quick, because obviously we just had the CPI print in the US, which came in at around 3.7%. That's 0.6% higher than the last month. This was expected because obviously if you look at the oil prices or energy prices in general, they have been surging quite significantly. I think oil is up over 10% in the last month, and obviously that weighs in on the CPI. But yeah, overall, I think core CPI came down to 4.3%. So that's obviously a slowdown, and that's why if we look at CME Fed Watch tool, we can see that most of the market participants still expect no interest rate hike during the next FOMC meeting, but let's see how it plays out. I think what's really important to point out as well is just the correlation to traditional markets. As you might know, last year, the correlation between Bitcoin and traditional markets has been quite high. This actually has been true for all the asset classes during this distress time, tended towards one. But yeah, over the last couple of weeks and just in general, we see very much a decoupling from Bitcoin to the traditional market, which obviously is wonderful because it always has been like an investment case that it could act as a diversifier potentially. If we look at the top news, what happened over the last couple of days, I think There's three that stood out. There's obviously more, but there's like the top three that stood out. First of all, we have Coinbase that announced that they might integrate, or they will integrate, the Lightning Network. For you guys who don't know, the Lightning Network is a layer 2 built on top of Bitcoin, which basically helps it to scale. And why it matters? The Lightning Network, there has been a lot of hype around the Lightning Network. It's a very promising project, and Bitcoin maxis, they absolutely love it. But to be really honest, in my opinion, it has been struggling to gain real traction. If we look, for instance, at the Lightning Network channels, the all-time high was around 85K, which is also almost a year ago. And now we're really consolidating. And at the moment, we have around, I think, 73,000 Lightning channels. So obviously, we hope that Coinbase's announcement kind of puts a new life into this project, because obviously it will improve the efficiency and the infrastructure, and it provides for the end user cheaper and more efficient transactions. Then next off, we have Metamask. They announced, or they launched, their so-called Snaps. Snaps, basically, it's like the first step of MetaMask's vision to build like a fully permissionless ecosystem. So it's basically a platform that allows like independent developers to build their own tools and solve certain problems. So a snap is essentially the feature or functionality that you can install within your MetaMask in order to unleash new functionalities. The good thing here, they're going to start with around over 30 different snaps that people can use. And most of them are focused on transaction insights. Some of them are focused on notifications. So basically, you can have dApp-specific notifications. And for me, the biggest one was around interoperability. So you basically can hold tokens from different layer ones in your MetaMask account. I don't know, Lina, Kareem, if you want to add something on that point.
I'm going to delve a bit deeper just to show one use case of how MetaMask is collaborating, how it's expanding its support for Solana, but we will talk about this in the next slide.
All right. And lastly, we had Telegram that is going to also launch a crypto wallet on top of the Tone network. And this has been announced during the Token 2049 conference that's happening in Singapore. And they also revealed the general plans to build out a Web3 ecosystem. I think the wallet, it will start in November, and obviously it could be a big deal because Telegram is used by over 800 million people. And it's obviously another step forward for people to use Web3 and integration between Web2 and Web3 applications. What's quite nice is that Telegram has been on the forefront of a lot of experiments. If you think about trading applications or trading bots like Unibot, which also launched on Telegram. So I think we will continue to see more and more projects when it comes to Telegram.
Quite intriguing, I would say, if I may, Adrian, because really a lot of the innovations that we're seeing on Telegram are just focused on abstracting away the crypto cumbersome process. It tries to simplify it as much as possible. So even though, as the example that Adrian just mentioned, Unibot, even though this is quite new, and there's still a lot of things to be improved on, it really could provide a way to onboard new users that are just completely linked and only use Telegram. So this is an exciting development that we should
absolutely. And maybe just to add, for people who never heard about the Tone network, is basically also a layer 1 blockchain, I would call it. And it has been launched, I think it was 2018, and initiated by Telegram. But then a year later, they stepped away because of some scrutiny by the SEC, because they raised over 1.7 billion during their ICO, and then the SEC came after them. They had a settlement a few years later, and now they're trying to pick it back up, basically. Let's see if it's a boost for the actual Tone network. I looked at the TVL. The TVL is quite low. At the moment, it has 6 projects, and the TVL is around 10 million. So it's really small. But they kind of announced that any project building on top of Tone, they get like priority access to the advertising platform from Telegram. So that's like their incentive and their attempt to attract more projects and developers. But let's see. And that's it from the current state of crypto. I think now we look at, as I mentioned, the bear market is here to build. And that's why we're going to look at the fundamentals and the most important upgrades and proposal. Karim, I hand it over to you.
Thank you, Adrian. So yeah, as we've just said, just as a quick recap, for all the user-facing applications like DeFi, like NFTs and whatnot, they all need an infrastructure layer in order to be hosted on top of it. So this is what we mean when we refer to smart contract platforms like layer ones or scalability solutions like layer twos, or even interoperability solutions like Cosmos. So essentially, over the past 2 to 3 weeks, there have been really just a series of upgrades that aim to improve on the network's underlying performance and efficiency. So first things first, even though this was not an upgrade related to Solana, like that the network itself, we saw a bunch of really interesting real-world integrations. So first of all, Visa announced at the beginning of last week that they are going to expand USD settlements to Solana. So for anyone who doesn't know, Visa has already experimenting with sending USDC, which is a US dollar-backed stablecoin. They've already been doing this on Ethereum for the past year or so. And essentially their purpose or their role for why they wanted to use Solana was for its low fees, for its instant settlement, and it's for geographical node distribution, meaning that if a natural disaster occurs and you have the nodes distributed around the world, the network would still keep running and it would not fall under a central point of failure. So this is really cool, just particularly because stablecoins are amongst the dominant use cases of crypto. For anyone who doesn't know, Ethereum was responsible for settling $3.01 trillion in Q1 of this year, just purely related to stablecoins, whereas Visa settled $3.04 trillion. So this obviously shows the huge appetite for stablecoins in the sense of instant and cheap transfer of money. So that was the first example. And then we also saw Shopify. Shopify is one of the largest online merchants, not online merchants, a service provider that connects businesses to users. So essentially, with the latest integration, businesses can now start receiving USDC payments from its users. And this integration will be with Solana Pay, the official payment provider for the Solana network. We also saw a really interesting upgrade or development really related to Avalanche. So Avalanche has something called Hyper SDKs. So that is essentially a framework to build highly customizable and highly performant blockchains. So Hyper SDKs, they have been announced for quite some time. They were introduced around the end of March of this year. However, the product hasn't fully gone live yet. The main reason is that it is essentially the evolution of all the primitive features that Avalanche has been reliant on for the past 2 years. So with Hyper SDKs, you are able to build something called a hyper chain, which is again a really high performant blockchain. What was really cool about it is that in a testnet experiment this week, they were able to record 143,000 transactions per second. This is obviously huge, but we have to be cautious because this was in a controlled environment, which means that in a practical environment, this probably would get halved down to 50K, which is still a really impressive figure for a blockchain. Because ultimately, we do want to compete against NASDAQ, Visa, and MasterCard, and relying on the low transaction throughput that is seen in the first generation of blockchains is not going to be the way forward. So this is really cool to see. So we've been talking about Polygon for quite some time now. They made a series of announcements spanning over July and August to introduce the Polygon 2.0 network. We're not going to get into the details of it, but we're just going to present the latest development that builds on what they have spoken about. So right now, they have something called Chain Development Kits, CDKs, which is, again, another framework that you could draw parallels with Avalanche in the sense of creating your own customizable network. That customizable network, it would be part of the Polygon ecosystem, and it would also enjoy native shared liquidity. This is a really crucial point that we have not seen in other scalability solutions or smart contract platforms. And this would be powered by zero knowledge proofs technology, in the sense that all the networks, since they are built on the infrastructure of the Polygon 2.0 network, using a shared bridge powered by zero knowledge proofs, would essentially transform this into a seamless experience. So this is really cool for Polygon because unified liquidity is a huge deal that we have been badly missing. Arbitrum, which is a scaling solution for Ethereum, it also introduced a really exciting upgrade. It's called Stylus, and it essentially, so just for context, if Ethereum and all its ETH compatible operating systems, they are programmed with a language called Solidity. So the downside of Solidity is that it's just limited to crypto, and for anyone who comes from outside the space, it's really hard for him to learn it, essentially. It doesn't have room outside of crypto. So with the Stylus upgrade, developers will now be able to code Arbitrum applications in Rust, C++, and C. This is also really cool because Rust, for instance, it's a smarter language, if you may, than Solidity, meaning that it checks for errors before it compiles the code in its final format. Obviously, this is really cool for security and to maintain a really low margin error. And then finally, Cosmos, which is an interoperability protocol that has been around for quite some time. Cosmos has been struggling for a variety of reasons, but for the most part, most of the other scaling solutions and smart contract platforms, they are starting to integrate interoperability in one way or the other. So Cosmos really doesn't have its shining advantage that it once had. And even that being said, the interoperability developments that are happening on other networks, they're not in their final stage yet, but it just shows why there's been an outflux of liquidity and user attention away from Cosmos to other blockchains. So the upgrade that is actually going to take place today, they are going to introduce something called a liquid staking module. So what is liquid staking? We've covered this before, but just for context for anyone who hasn't been around. Liquid staking is essentially, it's the evolution of staking. So with staking, you lock your token in a smart contract, and then you earn part of that native token to reward the fact that you are contributing to the validation of the network's security. With LSDs, rather than having to lock your token in a smart contract, you deposit your proof of stake token in a contract, and then you earn back something like an IOU, just a very analogous term to what is understood within the banking system. And that receipt that you get back, it allows you to still earn the staking yield, but at the same time having liquid access to your underlying asset, which means that you are able to use it across DeFi without any issues. And most importantly, this upgrade, it will switch or it will transform the current staking architecture of Cosmos, which is really cool because one of its biggest barriers is the fact that it has a 21-day unbonding period. That makes it really inefficient for people to withdraw their staked assets or their staked capital. So with the introduction of LSDs, the 21-day unbonding period will be addressed, and it really should help improve the liquidity conditions across the network. Of course, LSDs don't come without drawbacks. They do have their downsides. For instance, LSDs, since they represent the underlying token, they are supposed to be trading one-to-one. However, since this is a secondary token, if there is a huge selling pressure on one of those LSDs, then we could have the potentiality of the LSD depegging to the actual value of the underlying token. There's also the risk of validator power concentration. So what do I mean by that? Rather than having individuals stake on their own, a lot of people could use one liquid staking provider, and then he would have a lot of concentration over the security of the network itself. So this is obviously a very serious risk, but thankfully, one of the protocols called Stride, one of the oldest non-custodial staking providers on Cosmos, they introduced a blueprint for how this could be addressed, essentially by ensuring that the active delegation gets distributed evenly across a broader list of Cosmos delegators. So yeah, as you can see, the infrastructure vertical is really on the receiving end of a lot of upgrades. And it's going to be exciting to keep an eye on the vertical moving forward, or on the multiple verticals moving forward.
Awesome.
And let's just show a quick TVL illustration in the next slide. So just to give some context of how this is essentially all the networks that we have just mentioned. As you can see, they have all been going in down-only mood since the beginning of June, with the only exception being Base. Base, for reference, is Coinbase's scaling solution, and that's the one in silver. So as you might have known, Base launched almost a month ago, and a lot of cryptos, blue chips, and critical service providers have been launching there. However, as Adrian has already mentioned, due to the macro conditions and just the tough conditions, all the networks are getting affected. But the fundamentals or the price does not reflect the fundamental reality of these networks. So always important to keep that on the back of your mind. And then we can move on to talk about the latest exciting developments from the last week. Alrighty, so for anyone who remembers, we had something called Tornado Cash last year. It really has a bad or a negative stigma because let's quickly define what it is. Tornado Cash was a mixer. It was a way to essentially anonymize your financial activity. From the outside, it would seem like it is the perfect solution for money laundering and for illicit activities, but it's important to know that this is not the only use case for it. For instance, users living in authoritarian countries or regimes, they would want to maintain some sort of financial privacy to avoid censorship and a lot of other things. And most importantly, it doesn't also have to just be for the sake of protecting your identity. It could also be for financial privacy, like institutions in the current traditional finance or in the Web2 landscape. They don't broadcast their transactions and their financial activities to everyone because that's not really how the financial system works. And in order for us essentially to promote the real ways of crypto, we need some sort of financial privacy online, on chain. So what happened last week? Vitalik, the founder of Ethereum, along with a security researcher or the lead security researcher from Chain Analysis, along with security researchers from multiple universities, they introduced something called privacy pools. And the TLDR of it is that it's a privacy enhancing protocol. Its entire purpose is to obfuscate the identity of the sender and the receiver. And the way they do this is by pooling transactions together, mingling them, and then essentially separating them into different outputs. This is essentially what Tornado Cash was doing. The spin that privacy pools is introducing here is essentially the fact that users are able to generate a zero knowledge proof. So very quickly, a zero knowledge proof is the ability to prove that something without revealing its underlying contents, just without getting into the technology or how it's being implemented. So with this regard, a user, once he deposited his money into the pool, he can generate zero knowledge proof. And then based on that, you would have two associations, an association of honest deposits and an association of dishonest. The fact that you have your proof means that you are able to prove to corroborate the fact that you belong to the honest deposits. And the purpose of this, of course, would be to weed out the criminals and users who are linked to illicit activities. Finally, this is, as we all know, like public blockchains, they should be the evolution of TradFi's railways. However, the issue of over-transparency is not something that governments or institutions will compromise on. So this really does offer a promising solution. It most definitely won't be the final output that gets implemented, but it's a really promising start to a serious issue that crypto has been battling with for years now. And that would be my section.
I mean, I couldn't agree more with you on that. Obviously, the transparency of the blockchain is curse and blessing. But as you said, if like big financial institutions want to use a public blockchain, they need some solution in order to, keep their privacy, but at the same time comply with, KYC and AML measurements.
Absolutely. It's the only way to balance privacy along with compliance. Well, one of the ways.
Absolutely. No, very exciting. I think now after the very crypto native part, we're going to move back to a bit more of a hype. I think if we have some traditional bankers in the audience, then you're definitely familiar or you heard about tokenization, especially tokenization of real world assets. And Lena will give a little deep dive. What's the current state of that?
Hey guys, first I want to tell you why it's a hype and why we are hyped up about this. The reason why I personally like the idea of asset tokenization in the traditional form of things is because it gives traditional finance players the opportunity to see the real utility or the real USP and why blockchains matter. And we've seen this recently, actually. And here on the slide, I want to talk to you about what's been done so far on the real world asset tokenization and why is it a big deal. So Swift has been experimenting with Ethereum and Chainlink's CCIP protocol, which is an interoperability protocol, to find how Ethereum can actually benefit Swift as opposed to what they're using now. And after this experiment, they published a nice report telling us what the results were on August 31st. And they said that it really provided them with a single point of access to several networks that was not available previously without these solutions. London Stock Exchange was also mentioned in the headlines. The Financial Times reported that they've been exploring and studying blockchains for a year now. And they finally reported to the FT that they are planning to action this studying period and launch their own trading venue powered by blockchain. They did not report or disclose of the blockchain they are going to use, but they said that they were waiting for the public blockchain technology to mature and ready to use by investors. So we still don't know. Also, although this is not a trading venue for crypto assets, they're not going to facilitate crypto asset trades. It's still a win for the crypto industry because it acts as a stamp of approval of the underlying technology that ties all this, which is the blockchain technology. Some good news also has been happening, not in the adoption side, but more on the lobbying and educational side, which is a crucial element for mass adoption and for more players to jump on board. And that is the Tokenized Asset Coalition, joining so many crypto native companies and specialized companies for real world asset tokenization. And this coalition promises to accelerate the adoption process by providing educational material, advocacy, and innovation support. There has also been a report by the European securities regulator, ESMA. So the report was about risk assets and risk news so far. And one part of it was about tokenized bonds. And they mentioned that around $800 million worth of bonds were tokenized on distributed ledgers around the world. And this colorful chart on the right is what I'm talking about. So why are these guys doing this? What is in it for them? So why the big deal is it's a better user experience. Let's not kid ourselves. And I'm saying let's not kid ourselves because the traditional world does not really innovate because it's a traditional world at the end of the day. So many people work there for thousands of years. No one really has the incentive to improve it. But even within its infancy, this industry is always improving itself because it wants to prove itself. So there is a very fast settlement rate, not available with what we have in the traditional format now. And as Swift reported, they were able to have an access to several networks. And of course, with that, it reduces the operational costs because it reduces the operational cost to find ready-made ecosystems that could tokenize assets rather than building their entire ecosystem in a centralized manner. So that really reduces operational costs. And the next slide, I will talk about the background. Adrian, if you can do that for me. On the back end, who are the key players on the crypto native side? Who are the chains on our watch list that are tokenizing traditional assets? So as we've seen with Swift, Ethereum is still a king in this realm. And the case is true and also in the treasury market cap and the tokenized treasuries, US treasuries. It's still as the lion's share. But what has happened over the past year? So in June, Ethereum facilitated transaction between UBS and an investment banking arm of the Bank of China. And Polygon is also really capitalizing on this segment. In December, they facilitated the trade of billions of dollars from Hamilton Lane. And in November, they facilitated trades between Singapore and JP Morgan and Project Guardian. And they still have a lot going on in that specific segment. Polygon is a really interesting and promising project. They are still a little bit below, not a lot below Ethereum in adoption, but the grit and the partnerships they're forging left and right are really something to look forward to. And Avalanche, although they just launched their Avalanche Vista, which is a $50 million initiative to help tokenize several real world assets like equity, credit, real estate, commodities, and also blockchain native assets. They just launched it in July, but they have been in the works since last year. They facilitated trade with private equity giant KKR. They tokenized a portion of KKR's healthcare strategic growth fund on Avalanche. And Stellar is also a really fundamental player in this segment. As you can see on the chart here, it's a little bit close to what Ethereum has. And that is because it's the main advantage it has relatively over across the similar solutions is the cheaper issuance fees. And that is why the US Treasury's tokenizing on it is a lot more appealing. And they also have partnerships. They've been around for a while, and they have partnerships with like fintech solutions and solutions that work with like Web2 solutions like MoneyGram. So that is also something that Stellar has as an advantage. And that's basically it. One last thing could be that the future of this segment is really unmeasurable as of now. So many people, if you just Google it, you will find people saying it's $1 trillion opportunity, some say $1 billion opportunity. And that is because everyone can tokenize so much on blockchain. So the risks are basically because it's pegged to real world assets. The risk of real world assets are this risks of the tokenized real world assets. And there are also, especially with the real estate, as we've seen earlier this year, there are some regulatory risks. And if you want to read more about it, we have an entire section about asset tokenization, real world asset tokenization in not the last State of Crypto, but the one before in the Market Outlook. Thank you. And Adrian, the floor is yours.
No, I think just to give my 2 cents here as well, and the overall thesis, basically, I think all those financial giants, they see the future of the new generation of the internet. It's clear to me what the internet allowed us to do was basically sending information around the globe with the speed of light, with basically no cost. Let it be emails, video calls, content, information. You could just do it instantly around the globe, 24/7, leveraging the internet protocol. And now we're doing the same in Web3, but we take it to another level. So now we have this need for a global, neutral, decentralized settlement layer, which basically allows us to do the same with financial assets, with assets in general, with money. So we can send those assets around the globe with the speed of light, with the speed of the internet, basically, leveraging the blockchain technology. So for me, it's super exciting.
I think also, just as a last point to add on top of all of this, the fact that tokenization, due to the permissionless nature of crypto and blockchain, does unlock access to so many illiquid and inaccessible markets. This is a huge deal. It's not a small feature. So yeah, I think that is really something that needs to be always taken into consideration on top of what was already been discussed, which is reduced fees.
Absolutely. But obviously, we're at the very beginning of this. It's such an early technology that's just a bigger picture and the vision, but we still are very early. There's so much more to do, so much more to build. But I think we're seeing the early innings. Everything we mentioned today, also in terms of privacy, in terms of usability, there's so much that has to be done until we really see reach main adoption.
Absolutely.
And I think that's almost it from our side. Obviously, as usual, we have a QR code which you can scan in order to get access to our Dune analytics dashboards. We have our wonderful colleagues, Karim, Carlos, Tom. They build amazing, the best on-chain analytics dashboards. So please check it out. On-chain analysis is super important. I always say in the future there will be 3 types of analysis. It's technical analysis, it's fundamental analysis, and it's on-chain analysis, which is the capital markets of the future. So please check that out. And then obviously, just sign up for our research. We have weekly newsletters. We have our state of cryptos. And obviously, you're always up to date what's going on in the crypto market. And I think that's it from our side. We have some more time for Q&A. So if you have any questions, please feel free to shoot them into the chat.
We want to stay a little bit high level, and I have not done a deep dive on Centrifuge, but from what I read and what I've known in this subsector is that Centrifuge is one of the people or one of the companies that have facilitated real estate. Is that correct, Karim? And what I know also is that it's one of the main companies forming the coalition with RWA.XYZ. So it is one of the leaders here. Yeah.
Really has been one of the leading providers providing the TIN, I think I'm spelling it correctly, TIN Lackey smart contract platform, which is the tool that essentially allows for the tokenization of the actual assets. So I would say Centrifuge, and by the way, this is not financial advice. It's not sponsoring or promoting any of these projects. It's just simply what we're seeing on chain. I think it's Centrifuge, Maple, and Goldfinch. Those three have been at the forefront of either tradable income or whether it was in tokenized treasury. Yeah, those three protocols are really ones to keep an eye on.
No, great. I think we have another question. Sorry, you wanted to add something, Karim?
No, I think I saw the first question that we couldn't see at the start.
Okay, here we go. The next one is, speaking about infrastructure, what is your view on Bitcoin miners? They have been struggling with real world issues, and publicly priced miners suffered quite heavily compared. Any view on the BTC mining industry? I hope I understood the question correctly. Obviously, a lot of Bitcoin mining companies are under a lot of pressure as well. It's two-sided, I would say. At one point, the hash rate is at an all-time high. So we clearly see that the Bitcoin network is steadily growing, which is a good sign, absolutely. But on the same side, obviously, we have higher energy prices and lower Bitcoin prices. So obviously, that puts a lot of pressure on the mining industry, which is also reflected on a lot of the stocks, or if we just look at some of those ETFs that are around. Another challenge will obviously be the next halving, because obviously the block rewards will be cut in half. But I think it's nothing unnatural that we haven't seen before. Obviously, there could also always be a capitulation of a lot of Bitcoin miners that have poor cash operations. But basically, even if a lot of those miners drop off, there will be a difficult adjustment in the Bitcoin network, which will attract more miners to plug in again. So that's the beauty, that it's self-adjusting. I don't know if you, Lina, Karim, if you want to add something on that.
Just something that was quite interesting in late Q2, early Q3, the fact that we saw ordinals and some of the smart contract innovations on Bitcoin.
Good point.
Of course, it's very clear that a lot of it was driven by hype initially, just because of the fact that it was the first digital artifact in the modern day Bitcoin. Because, by the way, the first NFTs that were ever present existed on Bitcoin. So just for historical context. But however, with the newer innovations that we saw recently, this could be something that helps reward miners as an additional revenue to the block emissions. How efficient that will be, this really depends on the scalability solutions and on the scalability solutions that really increase the throughput and the efficiency of Bitcoin. Because ultimately, with its slow properties or limited properties, yeah, it's not really the ideal platform to host these kind of innovations. But if this does change, then we could potentially see a resurgence and an influx of miners, actually.
Absolutely, yeah. The next question we have is
Polygon.
So Polygon 2.0 versus their legacy POS chain.
Just for context, the core or the legacy proof of stake chain, it's going to get upgraded to a ZK EVM chain. This has not happened yet, and the proposal is not live yet, but this was essentially Polygon's plan. They announced the 2.0 network. Now, as for you as a developer or for you as a company that wants to leverage the benefits of Polygon, I think really what we discussed today is going to be the key catalyst. Because what I mean here is Polygon SDKs. So just for context, if we remember Optimism Network 3-4 months ago, it really became super relevant after they launched their OP stack, which is the customizable framework that allows you to build your own custom network that caters to your specific regulatory and business needs. So I think that is really the way to go. And I think what makes Polygon even more distinguished than its counterparts is the fact that of what we discussed again today, the native shared liquidity. This is really a huge barrier for most of the other smart contracts platforms and scaling solutions. So this is really something that we are quite intrigued by, even though this is going to be quite a new form of innovation because we haven't had a zero knowledge powered bridge that yeah, this is quite new. So it will be interesting to see how battle tested this component will be.
Next one is, can you see more funds being completely on chain rather than using TradFi structure for custody? In terms of custody, the custody of coins, I think it's the safest if it's completely offline and in cold storage, obviously. But if we just talk about funds in general being on chain, I definitely see a future like that. I could envision the blockchain and a certain crypto project being the settlement layer and the financial infrastructure of the future. I think we talked about Avalanche earlier as well. And I think it's also in my opinion, it's an exciting project, especially due to their subnets. Basically, you can build a permissioned subnet, which basically, again, comes down to privacy and also being compliant, KYC, AML regulations. So you basically build a sub-chain that kind of enjoys all the benefits and advantages of a blockchain, but is secure, it is private, but it's also connected to the public network. So I think we see more and more developments like that. Do we have any more questions?
There's a follow-up of what I was just discussing in terms of native liquidity, but no, unfortunately not. This is all quite new, so we're going to see more and more of this. You should keep monitoring their Twitter and their Medium blog posts.
I think what I love about just zkEVM by Polygon is just that they're really committed. They're also more committed. It shows that EVM is becoming the standard or possibly becoming the standard. Obviously, with the sidechain, there was a long debate, or I can remember 1 or 2 years ago, we were like saying, okay, could Polygon become its own layer 1 chain? It was always hard to classify it. Is it a layer 2 solution or is it a layer 1? But now they really made that commitment to scale Ethereum, which is nice to see. And ties in with a lot of other projects that were a layer 1 in the past, but now committed to become a layer 2 or roll up on Ethereum. Any last words?
Don't let the bear market put you down or make you feel down. Honestly, there are like for anyone, you should actually check out DeFi Llama. I'm going to post it here on the chat, and I'm saying this mainly because one of the really interesting things about crypto this year has been real world assets. This subsector has been going in an up only mood since the beginning of the year. Its TVL right now, it has grown to almost 900 million, whereas this industry did not even exist a year ago. And it's crucial as well to highlight this because it's not exciting. There's no Ponzi aspect to it. It's actually just implementing and adopting the technology to its full potential. And if you really want to cut through the noise and have a better sense of where this industry and this technology is headed, real world assets is your perfect example. The shining light in the midst of a very gloomy first half of the year.
I think those are beautiful words to end this analyst call. Thank you so much, Kareem, Lina, and every person that tuned in. Thank you so much. Have a great day.
Thank you. Bye.
Bye-bye.